to again thank you for being on this call today with Monica Rebella CPA, President of Rebella Accountancy, which is a CPA firm that specializes in accounting, tax, and consulting services for hundreds of dentists in California. The topic of our call today is the finer points of the additional tax for no health care insurance. If you are not a current client of Rebella Accountancy or you have not met her, Monica Rebella is a CPA and has 26 years of accounting and tax expertise, which includes 13 years working with the Big Four, Big Eight firms, and over 13 years experience working with dental practices. She is past president of the Orange County, Long Beach chapter of the California Society of CPAs and is a member of the AICPA. She has conducted training sessions for accounting firms as well as lectured on tax and business matters to the California Society of CPAs, the UCLA Dental School, and the Orange County Dental Academy. She runs her own firm in Tustin, California, providing tax, accounting, and consulting services for over 300 businesses throughout California, specializing in dental offices and small businesses. Monica, welcome to the call.
Well, thank you, Jeff, and thank you to everyone on the webinar this evening. I know you're just dying to find out more about Obamacare. I know just top of your list, but you know, I get calls on this, and I find there's some misinformation out there. So not only is it for you to think about as the dentists and the doctors that own the practice, but some of your employees may be confused about this as well. I've had some calls because the staff aren't quite sure how this works. So I'm going to go through some of the finer points of the Obamacare thing, and you know, this is kind of one of those things where you keep shaking it and more things come out. You know, it's 2,000 pages long, and sifting through it is just taking a long time, and more things keep coming at us. So let's get into these finer points of the new tax. Remember, the Supreme Court said that this is actually a tax for not having health insurance. So it falls on your personal tax return. It falls into us people that do taxes as well as the IRS to deal with. It has nothing to do with, you know, a penalty for not having it for your business. It clearly comes to your personal tax return. Isn't that awesome? Now, for most of you and most of my clients, you've got health insurance. You're already covered. You've got it. You know it's important to have that health insurance, so you're not going uncovered. It would be your employees. I will say that I've got a rare case where a doctor doesn't have it, and we're working through that. But really, most of my clients are covered with health insurance. So here's what we're going to cover. We're going to talk about how this additional tax for not having health insurance beginning this year, 2014, works. We're going to talk about the new rules. This is some of the new things falling out of Obamacare, the new rules on how you can reimburse your employees if you so choose to as the employer, for having their own health insurance, paying for their own health insurance. Some of my doctors have decided they aren't going to get group coverage, but they want to give some money to the employees to help them get coverage. And then we're going to talk about the new rules about reimbursement for out-of-pocket medical expenses. Again, another one of these things that's falling out of the Obamacare. So we're going to go on. We're going to start with the additional tax for no health insurance on slide 3. This is it, 2014, we're here. So all U.S. citizens and U.S. residents without health insurance are going to be subject to this. In 2014, here's how the tax works. Here's what most people have heard. $95 is the penalty for not having health insurance in 2014. Maybe. That's if you're single and you have no dependents. It's $95. That's correct, and if your income's low enough. But here's the real deal. It's $95 for everyone in the household that's an adult and $47.50 for each child in the household. We start there. And then, or, let's go to slide 4, 1% of the total amount of income on bottom of page 1 of your personal return. So it's the $95 a person as an adult, $47.50 for kids, or 1% of the income on page 1 of your tax return at the bottom. It's the higher of. Then there is a cap. So the cap on this is the penalty cannot exceed 300% of the household penalty. Okay? It cannot exceed 300% of the household penalty. And the amount cannot be larger than the national bronze level insurance premiums, which are $4,500 to $5,000 if you're single, $12,000 to $12,500 if you're a family. So we do have caps on how much it could be. So let's go on to slide 5. Here's an example on slide 5. Real simple example. We've got a family of 4, 2 adults and 2 children in the household. Their total income on the bottom of page 1 is $70,000. We need to know all of this to try and figure out what they're going to pay for not having health insurance. So their minimum penalty would be the higher of $95 times the 2 adults plus $47.50 for the 2 children, or $285, that's where we start, or 1% of their total income on page 1 of their tax return at the bottom. 1% of $70,000 is $700. So you'd say, okay, it's the $700. Well, let's go on, because remember there were caps. Let's go to page 6. So we know it's $700 for 1% of the $70,000. However, it cannot exceed 300% times the penalty in the household, which was the $285, 2 adults at $95, 2 children's at $47.50, times 300% is $855. So yes, their penalty would be the $700, the 1% of total income on the bottom of page 1 of their tax return. So there is a difference between that $285 they thought they were going to pay, $95 for each adult, and then half of that for each of the kids, versus the $700 that's going to be on their tax return. So surprise, surprise, it's going to be a higher penalty than they thought. Now what I didn't get into here, and I'll just at the top of the iceberg here talk about it, is this family is more than likely going to the federal or state exchanges and getting a credit for getting health insurance, which will offset this. So they would be able to go to the exchanges. They would be able to get a subsidized health insurance premium that would offset this. So if they get health insurance, they don't have the penalty. But we're dealing with a family that isn't doing that. They're not going to go to the exchanges, and they're just going to pay this penalty. So that's how this family is going to work out for no health insurance. Slide 7 is a nice little picture for you to look at. Here's the penalty and the amounts going from 2014, 2015, and 2016. That's all that we know. These are the 3 years that they gave us what the penalty amounts are going to be. Beyond 2016, we don't know. We don't have any additional information past 2016. But take a look at this. So we just looked at 2014. The $95 an adult in the household, $47.50 for each child, up to $285 per household. That's based on 4 people, or, as we calculated, 1% of yearly household income at the bottom of page 1 on the tax return. So we went through that. Now what's given in here is also where you start calculating the 1% of total income. You can see in 2014 it tells you at $28,500, the family over $28,500 on page 1 of their tax return, they will get into the 1% of total income to calculate the penalty. Okay, that's the dollar amount where you switch over to 1% of income. Move to 2015, you can see the penalty is $325 per adult, $162.50 a child, $975 for the household now based on 2 adults, 2 children. And it tells you that anything over $48,750 on the bottom of page 1 of the return, they are now going to the 2% of total income. It's no longer 1%. Now it's 2% of the total income on the bottom of first page of the tax return. So you can see it's going up. And now we get into 2016. It jumps to $695 an adult, $347.50 a child. Now it's a penalty of $2,085 per household. Or, and you can see in here that at $83,400, anything over $83,400 on the bottom of page 1 of a tax return is going to go to 2.5% penalty of that. So you can see that by 2016, $2,000 in penalties, maybe you want to go look at health insurance, especially if you can get some kind of a subsidy. So this quickly gives you the next 3 years on how that goes. But remember, there are those caps, so that gets you out there. 300% of the total amount of the household penalty is a cap, and also you can't go beyond what the bronze levels are. So it gives you kind of a nice snapshot. Page 8, just a couple more things about not having health insurance. These are the really finer points. The tax for no health insurance is actually calculated on a month-to-month basis. It's not flat, here it is when you do your tax return. It actually is based on a month-to-month. So if you did not get health insurance by April 15th, 2014, so you're still without insurance, and you mix the deadline, let's say you lost your job, or let's say that your health insurance ceased for some reason. You didn't make premiums and you lost your health insurance, or you lost your job and so you don't have it anymore, or your employer stopped providing it. Okay, so let's say that any of those things happened to you. And we're going to go on to slide 9. So on slide 9, here's the deal. If you lose your job or you don't have your health insurance anymore, you have 3 months to get new health insurance coverage. So let's say you get laid off in June, and that means you don't have any health insurance because your employer was providing it. You have until September 30th to get new health insurance. Now, if you don't have a job, you're probably saying, how can I afford it? Well, we're hoping you get a new job in that time, and you do have money to do it. Now, you also have to make sure that the health insurance you have meets all the requirements. They got all these minimum coverage things that you have to do and have included in your insurance to be the right kind of insurance to get out from underneath this. So you get 3 extra months. That's why it was supposed to be by March you got insurance, March of 2014, and then President Obama extended it to April 15th to do that. That was that 3 months to get insurance. But now that's used up. So if you still don't have insurance, you're going to get it calculated month by month. If you lose insurance, you get 3 months to do it. But if you don't get it in 3 months, it's a month-to-month calculation. There's a lot more information at a website called ObamaCareFacts.com. It'll go through what these minimum coverages are when you get insurance that you have to make sure it includes there for you, and a lot of other information. So go to slide 10. Here's another fine point about the health insurance. If you have an adult child living with you who you can't take as a dependent because the child's out of college, they make more than $3,000, but they don't make enough to file their own tax return, they're in your household, and they need to be included in the calculation of not having health insurance if they don't have health insurance. And it's going to be tricky because they're not going to be on your tax return. They're not your dependent, but yet they don't file a return. So it's going to be very interesting, but you have to make sure you tell your tax person, everybody in the household, and what the situation is, because it is on the parent to include this if this adult child's not filing their own return, even if they're not your dependent. So it's going to get tricky. And on slide 11, here is some interesting facts and maybe a strategy here. The IRS cannot lien, they cannot levy, and they cannot send you to jail for not paying this new tax for failure to have health insurance. Okay? They can't lien, they can't levy, they can't send you to jail. They can only get this money if you pay it, or if you have a refund, they'll keep your refund money until you've paid the tax. So if you're thinking of a strategy here, because you don't want to pay this, you think it's wrong, owe tax come April 15th. Particularly owe this additional tax for not having insurance if you don't have it. So if that's all you ever owe, and you always owe, the IRS can only send you, please, please, please send us the money. There's nothing more they can do than ask you. So there is no teeth to this for the IRS to collect at this point. Congress is aware of it, but at this point there's no teeth in this for the IRS. They can only send you, please, please, please send us the money, unless you leave money there for them in the way of refunds. So if you need a strategy, if you're thinking of it, that would be potentially the strategy if you completely disagree with this tax. So on slide 12, we're moving on now from how the tax is calculated from not having health insurance and those finer points to let's talk about what I see happening in dental practices and other offices. You're not required to provide health insurance for your employees. You don't have 50 full-time employees, so you don't have to do it. You're not under Obamacare to have to provide health insurance. You used to have group insurance, or maybe you never had group insurance for your office, but you want to give your employees some money towards them buying their own insurance, okay? And I have seen this. In fact, I reimburse my employees for getting their own health insurance. Some people used to put it as a separate check, and they used to put it under benefits, employee benefits, or health care reimbursement. Not anymore. Beginning January 1st, 2014, if you're going to do this for your employees, it must be through payroll. You must add it to their payroll check as a reimbursement towards their health insurance. They must turn into you, this is how much I paid for health insurance on a monthly basis, or give you information that this is how much they are required to pay, and then through payroll you add it as an expense reimbursement on the back end of their check after taxes are withheld. It's an additional reimbursement from you added to their payroll. It must be done through payroll. It cannot be a separate check anymore. It must be part of their payroll check. I want to be very clear on that. And if you've already been doing this, we need to talk if you're my clients. If you're not my clients, I'll certainly talk through you how you can do this if you haven't done it yet this year. So let's go on to slide number 13. And here's our last subject, which is reimbursing employees for out-of-pocket medical. This is what I also see in a lot of my doctors' financial statements is healthcare reimbursement. And what I find is that is all the out-of-pocket medical expenses for the doctor and their family. Sometimes it's employees, but mostly it's the doctor and their family. You cannot do that anymore. There is a way to do it, but you must have a separate plan, and only the doctor and the family can be the employees, or you are paying for all the out-of-pocket for your staff as well. So you can't have that category healthcare reimbursement anymore where it's just the company paying for your out-of-pocket medical expenses. You must have a plan, okay? So if you haven't done that again and you're my client, please call, or if you're not, call and I can walk you through it. These out-of-pocket medical expenses, a lot of times what we did was set up a cafeteria plan or flexible spending accounts. I have it from my office. Many of my doctors have it. It's done with the employee's own money, so it's part of their payroll. Again, it's payroll. The employees say, look, I want $2,000 of my own wages, doctor's not putting any money in for this, my own wages to be out-of-pocket medical expenses this year, okay? And so they're saying that they know they're going to go to the orthodontist. It's going to cost $2,000 for braces for their kids, okay? And so they're going to reduce their W-2 wages. They're not going to have to pay tax on it. Then they're going to have taxes withheld on everything other than the $2,000, and they're going to get $2,000 without any taxes withheld on the back end of their payroll check, okay? This was $5,000 as the maximum until 2013. Part of Obamacare cut it in half to $2,500. This started in 2013, so we're a year and a half into this, that this new level for out-of-pocket medical through cafeteria plan or flexible spending is $2,500 a year, and it cannot be over-the-counter drugs. So if they have Claritin or aspirin or Tylenol, it cannot be over-the-counter drugs. It really must be prescription drugs and anything they pay to doctors. Okay? So we're going to go on to slide 15. More of the out-of-pocket thing. The only other thing I'm going to say, and this started this year, is they cannot get reimbursed any longer for their health insurance premiums through the cafeteria plan or flexible spending. When they say out-of-pocket medical, they mean out-of-pocket prescriptions, doctor visits, but not health insurance premiums. So just want to make sure it's clear in that that's this year. They cannot have the health insurance premiums be these out-of-pocket expenses. So that concludes what I have on those finer points of Obamacare. really it is those fine-tuning things that we just have to make sure that we're aware of. Do them right, get any reimbursements through payroll, and understanding truly what the penalty is and how it's calculated and how it is going to go up gradually over the next couple of years. Because I know some of my doctors are getting these questions from their staff. And some of my doctors, if they decided not to do group health insurance, they're potentially thinking they might reimburse the employees for these additional taxes for not having health insurance. Really, before you go down that road, if reimbursing the employee for these penalties for not having health insurance, talk to me if I'm your CPA, or if I'm not your CPA, talk to your CPA about doing that before you do it. You really need to flesh out the issues of whether that's appropriate or not. So that's what I have on my slides. Jeff, do we have anybody with calls or questions?
I'm looking, Monica, on the Q&A side, and I don't see any coming through the webcast. And on the phones, we've opened up the line, so if you do have a question, you're welcome to ask that. I have a quick question on the cafeteria plans. Did those used to be called HSAs or health savings accounts? Is that another name for them, the flexible spending accounts? No?
No, no, that's not. The cafeteria plans became flexible spending. An HSA account, health savings account, is a specific tax deduction if the employer has an insurance plan or the employee buys their own insurance plan that's called a qualified health insurance for HSA. So it has to be a qualified high deductible, I'll put that in there, a qualified high deductible health insurance plan that qualifies for a health savings account. And it must be that. I had a doctor that had a $5,000 deductible, which sounds like a really high deductible plan for me. I had him check, and it was not a qualified high deductible plan for purposes of an HSA, health savings account. So you must have that kind of a health plan to be able to have a health savings account. A health savings account is a tax deduction on your personal return for putting money away for your own health insurance out-of-pocket costs. Okay? So it is something new that came about in 2011, 10. It's been a while. I can't remember exactly. I apologize. But it has come in for a while ago, and it is specifically encouraging you to put your own money away for health insurance and health costs, and you get a tax deduction for it. There is a maximum per year, what the tax deduction is, but when you pull that money out, it's tax-free. So if you go in and get into this account to pay for your out-of-pocket medical prescriptions and doctor visits, it's tax-free. It's the only thing that we get a tax deduction for, that when you take it out and use it, you don't pay any tax on it. It's absolutely phenomenal. So again, if you can get a high deductible qualified health plan for health savings account, it's definitely a good way to go. But I will tell you, if you get that, I had one doctor tell me, he looked into it, his prescription medicines go way up because you're no longer on a plan that covers, you get a small copay for your prescriptions. All of a sudden your prescription medicine can shoot through the roof. So before you go down there, you've got to make sure you analyze my tax deduction, reduction in taxes, get to pull that money out tax-free, but what's it going to do to my real costs of my prescriptions versus having a different health insurance that covers lower prescriptions.
Got it. Interesting distinction. Thank you very much. Well, I don't see any phone calls coming through, so we've answered, it looks like, all those questions. No Q&As on the Internet side. So, Monica, again, thank you very much for taking the time out of your schedule to give everybody this update on Obamacare. If somebody is not your client and they do have a question about this, what's the best way to contact you via phone and email?
The best way to contact me by phone number is 714-619-0667, and it's the last slide in here. Again, it's 714-619-0667, or you can reach me by email. My email is mrebella@RebellaCPA.com, and Rebella is spelled with an E, no U. I'm not the German measles, so it's Monica Rebella, REBELLA, CPA.com.
Great. Monica, thanks again, and we want to thank, again, everybody listening on the call live or on the replay. You've been listening to Monica Rebella, CPA, and tonight's webinar was the finer points of the additional tax for no health insurance. And again, if you have any questions, feel free to get a hold of Monica. Thanks again, everybody. Thanks, Monica. Take care.
Thank you, Jeff. Take care.